Welcome everyone. Welcome to the Never Go Broke Again webinar. I'm going to give a few moments here as everyone gets settled in, and then I'm going to got my notes here, so make sure I don't leave anything out. But I think this is going to be very useful for a lot of people. I just primarily the reason I did this is because I saw that over the last few years, a lot of times people they are in positions or they even make some of the right decisions and get into some really good investments, but they either don't know when to get out or they end up over leveraging themselves and they have to start over. So I wanted to prevent that so that we're building wealth year over year and it's not a consistent roller coaster where I'm in this play and then oops, I messed up, got to start over, or I'm in this play and oops, I messed up, I got to start over. So I just wanted to give out the blueprint here that I believe it can give people the opportunity to kind of stair step their way regardless of what's going on, but still give them exposure to a lot of the higher upsides. One thing I see inside of my group, the Anomalous Investor, is we want to have unlimited upside, but we want to have control and take moderation here to our downside so that we're not just having maximum exposure or our entire capital or investment is completely exposed at any given time. So that's the reason I named this Never Go Broke Again, because the outline, that and stuff that we're going to give is going to prevent that from happening. I'm going to have some slides and stuff pulled up, even just going over your portfolio setup, which is going to be step number 1. So I'll pull those up. They'll appear on the screen and stuff like that when you're watching this, and it'll ultimately just kind of give you an idea. You don't have to necessarily use it. Again, these are my recommendations. I'm not a financial advisor, but you can certainly adjust them to your liking so that you can kind of have a setup here so that you're not kind of just winging it. So getting into it, number 1, portfolio setup. Ideally, if you are investing, now what I did typically is I did start trading even with options and stuff like that. And I did have a larger percentage in my account as I build up capital, but it wasn't 100%, right? You can use this for moderations. I get it. You don't have to use my story. It's a quick background. If you haven't seen my story, it's on my video, but I pretty much got my CDL, started truck driving, and I only had my car, got rid of my apartment, everything. And I only had my car and my cell phone as far as for bills or responsibility. And that allowed me to save up a lot of capital. It allowed me to have a lot of capital to invest and make, a lot of mistakes and learn and grow. And also took the pressure of, oh my God, I got so many different bills and stuff like that. So I need to kind of be, moderate with my aggression in investing. So again, that's not for everyone. I'm not recommending everybody get rid of everything and go live on the road and drive trucks to save money, but that's what I did. But if you're not in one of those situations, you want to kind of have some categories here that you can kind of balance your portfolio, because that's eventually what I ended up doing, so that I'm not, because obviously I wanted to have, somewhere to live and not necessarily be on the road, and even have most of my days, be behind, a steering wheel and being awake and stuff like that. So this is going to be that balanced approach that'll still get you there without taking the extremes. So with that being said, I'll share more of my story at a later date, but we're going to get into it. So number 1, options. This is going to be for technically like calls and puts and stuff like that. You can do around, typically what I believe is around 3 to 5%. That's what of your portfolio. And if you don't have a lot of cash, you're going to be like, oh my God, that's crazy. I don't have enough money and stuff like that. If you're being proficient, we're going to get into that. You're going to be able to rebalance this setup and make adjustments there. But you have to find out if you're proficient first versus just swinging your money. Because if you have a 3 to 5% of your cash available in options and you're losing 60, 70% of your plays, you don't need to have it there anyway. So, but we're going to get into that. Cash, you want to have 5% so that you can kind of jump on any investments here. So you're going to call that necessarily like buying power. What I call your bricks, your foundation, your home. I have 60%. That's what I think is going to be the really the foundation of you never going broke again. And this is going to be in some powerful indexes that are going to be like a lot of the foundations to the country, so that if these went to zero and your portfolio got blown up, not much would matter outside of that. As I'm talking about, like VOO, VTI, a lot of the index and stuff like that on Vanguard, ETFs, all that kind of good stuff like that. You're going to, outside of like Armageddon, it's rare that you're going to get screwed in that regard. So especially for a long term, typically these are going to appreciate. This is going to be attached to the actual economy of the overall country. You've heard of FANG. For individual stocks, you can have like 20% there. I do a little different. I do have Amazon. I have Tesla in there that I buy individual. I have Google, obviously, Microsoft, Apple. That's kind of like my FANG. I know it's not necessarily like FANG, but you can certainly have a decent blueprint to kind of go by. But I use some of the companies that I believe are going to emerge victorious over the next 5 to 10 years. So that's kind of like my setup. Typically people go with FANG, but those are my stocks that I like to individually, that I just go on a spree to buy. If they hit my certain price targets, those are the stocks that I go into, and I have around 20% there. Swing trades and stuff like that, you can do 10%. So that's going to be any of the, what you would call your meme plays and stuff like that, whatever you want to participate in as far as like short squeezes, things that you believe are undervalued right now, but you're not you don't believe that you want to hold them for a long period of time. So I don't like this stock, but I do believe that it's undervalued. So I'm going to purchase it now, and I'm going to get out of it. I think sometime within now and like 3-6 months from now, it's going to be at an appropriate value, or at least higher than what I purchased it. So I'm going to get in now and get out. I'm not holding this long term. I'm just looking to swing it. So that's kind of like the portfolio setup that you're going to want to go by. Again, you can kind of tweak this as we go through the numbers. Number 2, stick to a system, a chart result. So numbers are factual, emotions are not. And you're going to have to figure out your numbers. What I mean by this is, if you're looking to, a lot of times people want to either trade, even if they don't realize it, they're either swing trading or they're looking to day trade, whether that be stocks and or options. And even if they don't identify as that, their actions and where most of their money goes will say otherwise. So you need to know your win percentage. You need to be back testing your strategies. You need to say, okay, if I took 20 trades over the last month, how many of them did I win using this particular strategy? You don't need to be changing strategies and stuff like that. You need to be very organized when it comes to trading. If you're looking at something and you say, I'm reading candles and I'm using RSI, keep a note of those trades that you took using that setup, and to get your win percentage. And over here, if you're saying I'm using EMAs, MACD, and this is going to be my setup here, that's a separate group of trades. Keep track of those and you get your win percentage. You need to know which system is more effective for you, instead of just kind of compiling everything. Because a lot of times what the issue is, you're using this indicator over here and you're saying, okay, well, this indicator tells me to do this and I'm going to get in. And then next week you're using a different indicator, a different system, and you're not keeping track of what. You're going to have very mixed results, because the more indicators that you use, you're going to get conflicting data, because sometimes you can have 2, 3, 4 indicators and they'll all be telling you to do different things. Some will be telling you to get in, some will be telling you to get out. And when you start mixing your systems here, or you don't have a system, it's going to be very confusing to get predictable results, and how to even make an entry, exit, or evaluate properly an asset, because you have to have a system and stick to it and figure out which system that you're using is going to benefit you the most. Because if you're just looking, if you don't have a system and you're just looking for something to validate what you already want to do, then you'll find it. And you're not going to have the results here that you want. You want to be able to trade and say, my system here is going to, I win most of my trades. I win the most amount of trades with this particular system. this is the system that I'm going to enter this trade with. If it tells me not to get in, I'm not. If it tells me to get in, I will. I'm not going to go searching for an indicator that pretty much validates what I already want to do, because this again gives you unpredictable results. Because if you're going to keep searching for something that tells you to do what you want to do, you might as well just do it. And and you're going to have those kind of like mixed results. So you want to just kind of make sure that you are keeping the money and having predictable results. So kind of like Warren Buffett said something along the lines, mine is a little different, but rule number 1, make the money. Rule number 2, keep the money. Those are the rules. So you have to, in order to do that, you're going to have to be able to evaluate your numbers and know them in the first place, right? Number 3, decide if you're going to be a long-term or short-term investor, or a combination of both. The setup I gave you is a combination of both. A lot of people are combinations of both. It doesn't mean that you have to lean toward one particular direction or another, but you have to know why you're getting a particular asset. So a lot of times most people are short-term investors because they want money right now, which is fine. You just have to kind of know that and develop a strategy to do such a thing and make sure that it aligns, because ultimately what happens is people are short-term investors, but they're not evaluating how to properly get into an asset or get out. And the asset typically turns against them, or it goes deep into the red. And now they're like, oh, okay, well, you didn't want to be a long-term investor, but you're forced to become a long-term investor because of your entry. So now you're in a position where, okay, I have to have a bunch of money to DCA down to kind of put myself closer to profit or in profit. And then now I have to kind of hold. And this is another reason, one of the many reasons why you don't go 100% in, because if an investment does go against you and you're not 100% in, and you're like, okay, well, obviously I made a mistake here. I don't want to be in this investment anymore. You have the cash to DCA down and get out. But if you're 100% in, you're stuck, and you have to sell at a loss, and you've lost your leverage. And in the market, you don't want to lose your leverage here. There's a lot of big players out here, big fish, who have a lot of money, and you don't want to be in a position here where you wanted to be short and now you're long due to unforeseen circumstances here and bad entries. Because technically speaking, this is one of the things that we talked about inside the group here for a while. There really is there's technically not a bad investment. For the most part, you can make money on just about anything. It's really your entry that determines whether or not the investment was bad. So if you make a proper entry or decent entry, no matter what it is, typically you can turn a profit. So you have to kind of keep that in mind here. So if you're evaluating things and say, okay, I want to be long-term, I'm going to do the long-term approach, that's fine. But you just have to keep in mind that you're not going to have access to money right now, and you're going to have to be consistent and disciplined with that. But I recommend everybody does that so that you're not blowing up your portfolio every time you lose a trade. Nobody's shooting 100% out here. So if you're saying I'm going to invest $100 a month for the next 20 years or something like that, be consistent with it. But one of the things I recommend inside of my group, and it's one of the things that I really enjoy teaching, is trading and how to make money right now. That's the reason why I took my dramatic approach, even with truck driving, get rid of all my stuff. It was just being honest here. I know that all of you have seen the invest for 30 years and you'll be a millionaire by the time you're 65. That was not attractive to me at all. I did not want to hear that. That was that was almost depressing to me. So that's why I took the dramatic approach. I was like, I can't do the 65 thing. I don't mind having it. I don't think anybody will be like, if they're fortunate enough to live to be 65 and say, oh my God, I have too much money. I wish I haven't heard anyone make that conversation yet, but I wanted to be able to make some money right now. So that's why I kind of did both. And I took the aggression, especially at that time, in my late 20s. I was like, if I mess up, I can rebuild. I can develop. I can devote some years to this to kind of get an idea of what I'm doing and become proficient enough to generate revenue. And and that's what happened. I think most people can, if they are consistent and they're studying, they can do this. I got some mentors. I read a lot of books, all that kind of good stuff, and I was able to make that adjustment. And I believe most people can, but I'm not ruling out the long side as well. So I will never tell you just to screw everything, focus on the right now. But there's a time and a season for both, and you kind of want to make sure that your portfolio kind of has both in mind. You don't necessarily want to be completely short-sighted. Let's want to make sure I'm going through my notes here. I want to make sure I got everything because I'm kind of glancing at it and going on my little rants. Let's see. Yeah, right now money, all that kind of good stuff. And even for a lot of the shares and stuff like that, for a long term, like a lot of the shares that I was mentioning earlier, Microsoft, Apple, Tesla, they can be relatively expensive depending on your financial situation. And they're not out of reach for a lot of people anymore. You have the opportunity to buy fractional shares. So you don't have to necessarily come up with all the money. You can just put a certain amount of money in there, whatever you actually can afford, and you're able to get exposure to those particular assets. So things have changed dramatically, and you have the opportunity to have access to a lot of things that 10 years ago wasn't possible. So if you're looking to kind of balance out that portfolio long term and trade and stuff like that, you're certainly welcome inside of the group here on Harmless Investors and Investing long term. You have a lot of the blue chips here that literally our economy is attached to. Again, Apple, Microsoft, Google, all that kind of good stuff. And you don't have to necessarily buy the share outright. You can put $50 in there and it will divide it up. You can do fractional shares and you have exposure to those titans. So that can certainly work out. Number 4 I want to get into is protect the money. Protecting the money is something that most people do not do when they are investing. And typically what you want to do with this is you want to have a stop loss or a rolling stop loss. But this is, you never want to risk your entire investment. And I think a lot of times people do that, they'll just invest and hope it goes up and pray it doesn't go down. And that's not an effective strategy. We have tools to prevent that. And I recommend, I know all of you are using different platforms and in different countries and stuff like that, and that watch my videos, but stop loss is a very important tool. And I highly recommend it is worth the time to put in to study this so that you are limiting your downside. Yes, you're going to get kicked out of some investments that eventually would have turned profitable. Yes, you're going to have an investment go down, and because institutions, they can see where the stop losses are. Yes, they will drive an asset down, trigger your stop loss, kick you out, and then it'll take off. Yes, all of this happens, absolutely. But you will never lose 100. Well, because sometimes stop losses, you have to keep an eye on it as well, because sometimes they don't, they can, depending on the platform and depending on how many people in there, because we've seen some crazy things over the last few years. I want to put that out there. We can see things that don't execute, but typically you do not lose your entire balance here. You don't invest, $10,000 and then it goes to zero for, whatever random reason. You have that stop loss in there that's going to align with your risk tolerance, and that's something you're going to have to decide. But investing is like, stop losses are like the insurance of the stock market. It's like you go swimming and you go out into the ocean. It's like your life vest or your spare boat, your flare gun, whatever analogy you want to use. That is your safety net to make sure that you get out of this thing alive. And that's what I want for all of you. The stop loss, again, it's your friend. If you're trading, trailing stop loss is going to be your friend. Again, like I said earlier in the video, we want unlimited upside and we want managed downside. Trailing stop loss is going to do that. It's literally going to track your investment, and as your investment goes up, it's going to trail it by a certain percentage, a certain amount. And once it goes down by that much, you can lock in your profit. So let's say you're trading and you say, okay, I'm in profit at $50. If I'm going to put a trailing stop loss at anytime that this asset falls 50 cents. So it's just running 51, 52, 53. Your profit is locked in. It drops 50 cents. You're kicked out. So you've locked in unlimited upside. So if it's at, say it runs to $58, but then it goes down to $57.50, it's going to kick you out. You've locked in profit of that $8.50 per share. So $7.50 per share, and it's going to be it's just a glorious thing versus you sitting there trying to time it, trying to watch it. I'm sure if some of you have been trading long enough or investing long enough, you know that you can be in the green. You can go to the fridge, get some water, come back, and you're 20% in the red. Like the market changes tides like that relatively quickly. This is going to prevent that. Stop loss is you picking a certain number. So let's just say it's using that same example. It's at 58, and you say, okay, at $55, I'm going to lock in my profit. If it comes down, I don't want a trailing stop loss because I don't want to get kicked out. I believe this is still going to go up. And if it goes down to $55, I'm in profit at 50, but if it goes down to $55, at that point, I want to take profit. And you can do that as well. And both of them, again, not telling you which one is better. In my opinion, I believe it's trailing stop loss. So if you're trading, but both of them is going to prevent you from blowing up your account and from going broke. So it's really beneficial to really just to have that protection of your capital in there. I hate seeing people who make good investments, but just because of their overexposure, they end up losing money. In my closing remarks, you do not need to get rich off of one play. There's always going to be another play. Stock market's been around for over 100 years. It's going to be around after you're gone. This is not going to be the end all be all of any particular play. This stock market has been paying out millions, billions, and trillions of dollars all along. And if you focus on building a skill set, you'll be able to enter the market and come out of it with money. You do not have to invest everything and blow up your account and run through $10, $20, $30,000. And then now you have to spend the next few years trying to build up your account again. Protect your money. You worked hard for your money. Protect it. Invest wisely in your education and learning and being strategic with these steps and stuff that I gave you in this video. And you're going to be able to just ride the tides here and become a proficient investor. That's what I believe. That's the purpose of my channel. I want that for all of you. So just be patient and put those strategies in place here and make sure that you're limiting the downside. Those are the steps I believe to kind of put this portfolio in order and add some structure there. And like my never go broke formula. If you found value in that, I'd certainly like to invite you guys to join the Anomalous Investor Group. It's my group that I've been created. I have a trading course in there, Options 101. I'm going to be adding a tremendous amount of things inside that group across many different industries. Real estate, there's a lot of different things that I've been involved in. I'm going to have one on budgeting. I'm going to have CPAs and stuff like that, going over different tools to kind of provide value for the group so that we as the Anomaly, as the investor group, can just level up and go to the next level and have those resources available to us so that we're not being taken advantage of in the markets or just literally having our pockets rent. So if you'd like to be a part of that, I have a link in the description section, or you can go to anomalousinvestor.com and there'll be more information on the website. So with that, appreciate all of you guys for tuning in. I hope this has provided tremendous value for you. Thank you, and I will see you on the channel as we provide additional updates and continue growing together. Wishing you all a very great and successful year, and I will see you in the next one.